Hello, hello. Now, can you hear me okay? Yes, I think we're all right. Good morning. Thank you so much for having me. My name is Tom Ferguson, and I'm the managing partner of Burnt Island Ventures, the water-focused venture fund. We're just approaching 100 million in AUM. We've invested over 60 million in 34 companies since early 2021, and we pride ourselves in being at the vanguard of proving that investing at the seed stage in water can be a very profitable undertaking indeed. Now, I'm aware that there are some contradictions at play here. I'm a Scotsman who sounds English, who lives in Brooklyn, who started a water-focused venture fund in the US, giving a speech on water finance in Saudi Arabia to people who really understand the value of water. I grew up with endless quantities of it falling out of the sky. So I'm aware that our contexts are rather different. But I hope you can bear with me because I come bearing good news about water financing. So it's really a pleasure to be with you this morning to describe a new chapter in the development of water as an investment theme. Now, we've called it the end of the beginning because we think something fundamental shifted this year, and we're excited to walk you through our logic for why we're now in a new defined era of water investment. First, I will look at the shift in the early stage market that happened from 2020 to 2025 that has laid a very promising platform indeed for the future of investment in the sector. Second, I want to take you through the logic of the emergence of a true growth market in water. And third, I'm going to make the case that there is an inevitable low-risk opportunity because major downstream capital has cottoned on to the water opportunity before the venture market has, which gives rise to some very interesting dynamics indeed. So in the last 5 years, something has changed in the investment world with regard to water. So in 2020, people were still viewing a water fund as a charity or an impact investment. Corporates were seeing water principally as a CSR risk, or the element of their operations they knew they needed but cared least about. That has fundamentally shifted. Whether it's through water scarcity, increasing prices, the propagation of data centers, or the financial results of some of the world's largest water companies, light bulbs have come on for public and private investors that water is a defensive, foundational, high-growth asset class. There's been the beginnings of a realization of what is true within our sector, that the tailwinds are inevitable, it's unidirectional, and the numbers involved are enormous. 1.6 trillion in CapEx and OpEx in 2025, growing at least 8%. And the most important tailwind to our sector is physical. The distortions happening as a result of global heating. This chart from GWI shows the escalation in excess inundation and drying events worldwide as measured through the gravitational pull of groundwater by NASA. The steadiness we have relied upon that you see there up to 2018 no longer holds true across the world. Variability is so difficult because water, wastewater, stormwater systems have to deal with extremes. And there is no question about the expansion of water's extremes. Massive inundation stories from Texas to the UK to the Philippines to Dubai are becoming so commonplace so as to be easily missed in the global press. Flooding events are up 6 times from 2000 with no sign of slowing as the air becomes more saturated with more evaporated water, increasing the ferocity and length of storms and inundation events. And the converse is also true. Extended drying events are also more commonplace. The drying of Europe, the potential need to relocate Tehran, the subsidence issues in the Central Valley of California, the extremes of the impact of global heating are placing unprecedented pressure on infrastructure, safety, and access. So this really is a $1.6 trillion market having a truck driven through it. And the beauty of it is, as an investment market, its breadth. We've just closed our 50 million seed fund 2, and out in the fundraising. To be in. This is colossal, but much more importantly, it's everywhere. From process water and water treatment across oil and gas, mining and metals, dairy, agriculture, to domestic applications, insurance, metals reclamation, sludge management, desalination, replenishment, and yes, of course, data centers. There are just so many water markets riddled with inefficiencies for smart people to come and build businesses. And supporting them is our business. At BIV, we're in the business of finding, funding, and supporting the best entrepreneurs in water in the world. So we are here to support the people who are building the vehicle. So to know where we are as an early stage financing market, it helps to see the world as it was when I started BIV. So I founded this firm because every investable asset class or vertical goes through the same process. Whether it's financial technology or property technology or cloud SaaS, AI went through a very accelerated version of this. All of them follow a pathway where there is a period of initiation, and then there is a ton of accelerated progress building on. So taking them in turn, first initiation, the pioneers, then the first wave of pioneers provide the first density of quality across startups. We knew this was happening in 2020, and it's the reason a successful seed fund was possible then, despite the difficulties of earlier efforts in the market. Second comes growth. This inflection happens when enough of the companies in the first wave hit scaling velocity with a product that is differentiated enough in the market, and when founders don't sell out early. This enables true new players that either become standalone companies or are purchased at revenue levels that were unlikely in the initiation phase, sparking the interest of other investors, entrepreneurs, and talent. And once growth companies emerge, while the top of the funnel of startups continues to build, feeding the growth stage, you get to a pattern where everybody agrees that the market is investable, and everybody said that they knew it was inevitable before it happened. Maybe they did, maybe they didn't. But that's the maturity phase. And it always astounds me that we're going through this process because we've been manipulating water. You've been manipulating water. We've all been water technologists for thousands of years. But only recently have we seen the emergence of water as a viable destination for capital at any kind of scale. And we still have a long way to go. But that critical mass of smart founders that we saw in 2020 has moved through the initiation stage, and the growth stage is here. This is a crucial time for the development of any sector, and it's when we see the first real exits on a venture timeline, the first recycling of capital and talent back into other startups, but also into my world, the investment world. These first larger moves bring in interest from larger players and also forced interesting conversations for the incumbents in the room. Do you accommodate? cooperate with, compete with, or purchase the companies coming down the funnel. So the box on the left here is what I saw in 2020 and 2021. Both of omission and commission, so making bad decisions not to invest and bad decisions to invest, and still have a margin of safety on being able to fund exceptional people in the deployment period of a fund. These companies that we saw in 2020 to 2022 have now been joined by another 15 founders from our Seed Fund 2 starting in 2023, and Aquamembranes from our Growth Fund, who were very grateful to receive an award at this conference on Monday. And it's working. Our overall graduation rate from the round that we invested in to a following round will be 92%. We only have a 2% loss ratio on capital invested. Fund 1 companies will do 80 million in revenue this year, 120 million in bookings. And half of them are either already profitable or have a clear pathway to being so. Fund 2's companies will do 35 million in revenue, and we're only in year 2 of the fund. So what you're seeing is these smart people building the companies that they said they would, moving through the fundraising stages, even though sometimes just a fundraising stage is a poor proxy for actual development. And this is symptomatic of an overall trend in water which we believe is permanent. The smart people are here, more and more of them every year, and they're building really good companies. I was lucky enough to start at Imagine H2O, the water accelerator, in 2015, and work directly with many of the non-BIV names on this slide. But what's crucial for you to note is that 5 years ago, that stage VC slices. This is due to the increasing number of companies moving through to the growth stage, though these numbers, unfortunately, are skewed slightly by a couple of large individual deals, at least one of them not a good idea. Now, all markets need liquidity. They need people to buy the companies that are being built. So what happens with exits is a fundamental indicator of the maturity of a market. Deals at scale are vital to prove. Up in the top right of private equity firms looking to transact on both the buy and the sell side. Now, the data is crystal clear there in the bottom right. Active deals are up 3.5x since 2020, and exits are up over 7 times. This pace will be maintained. Private equity has discovered the beauty of the water market with its predictable, sticky revenues, good unit economics, tailwinds from both renewal and demand for new capacity across utility and industrial and across the world. This is just a great business to be in. So what we have is growing companies running full steam ahead into the arms of pools of capital who are already sold on the sector. They're here, and they're here to stay. The only real well. You will see our logo here twice, and it's not a big visual typo. We established ourselves at the seed stage starting in 2020, predicated on the argument that I've just put forward to you. The talented founders we saw in 2020 and 2021 have now, to a large extent, built the companies they said they would. And guess what? There is no water-focused growth fund entering at the Series B or beyond. So we're building it. $75 million with a hard cap of $100 million. And we're more than a third of the way through raising it. And we're so excited to expand our investment activities following the maturation of the private investment market in water. We want to be a part of moving this sector up the next stage of the S-curve. Because our job, in the context of the expectation has implications for all the players. Now, for founders, for those of you in this room, this is very good news. The deals for Smart Cover, Urban, Locust View, Consigli are just the start. And as the exit market gets clearer, your companies get more valuable. So enjoy. Just don't raise your prices on us. For investors of all stripes, whether you're public, private, bond, private credit, special situations, whatever it is, water is something that you want exposure to now. This isn't a funny appendage of the market. It's foundational. Their revenue drivers are insulated from the business cycle. It's going to mature rapidly, and it doesn't pay to be late to the party. Corporates. Now, you're going to have some decisions to make. The sleepy days of yesteryear, where anyone who emerged from the Series A stage was both rare and affordable, are gone. Then you could pay relatively little to take on an extra value proposition for your customers or remove an emergent competitive threat. Now, that landscape is more complicated, not least because it is an increasingly target-rich environment for large companies who want to start playing in the sector. Now, really good startups are excellent wedge acquisitions because especially in water, they can't get past a certain stage without being fundamentally differentiated. And owning that differentiation is valuable. So just be aware of the changing of your competitive dynamics. Now, of course, there are many elements of financing that we have not covered. Nothing on credit, which will continue to emerge and needs to, especially in working capital provision. Nothing on the bond market, which we think are going to have a big year next year and in the years to come. There's very little on private markets. And now that's partly because I don't work in those markets, and it's important to stick to your circle of competence. But it's more because what you're looking at here is the core of the development and maturation of all of those other verticals. Sectors need to have a thriving ecosystem of new companies, of talent and treasure being recycled, of new companies finally getting really big in order for all those other areas of finance to be enabled. The beginning of the next wave means the finance environment in water is going to get rather interesting for an awful lot of people. I want to thank you for listening. Thank you so much to the SWA for having me, and I look forward to connecting with you over the rest of the day.